Okay, let's unpack this. You've given us a really fascinating look into the U.S. stock market. Right now, this is July 15th, 2025. And wow, what a dynamic landscape it is.
It really is.
We're seeing these two, incredibly powerful forces pulling on the market, almost in opposite directions sometimes.
hmm
One feels familiar, an economic driver, but the other one, that's a new, highly unpredictable variable.
Yeah, and what's truly striking is, well, just how rapidly the market's focus has shifted. It's not simply data dependent anymore, in that traditional sense.
Right.
Our sources show it's become acutely tweet dependent. This aggressive tariff talk is injecting a huge policy-driven variable right as we're waiting for key inflation data.
And there's more complexity too, right? This Powell political risk premium.
Exactly. It's not just background noise. The sources are saying the market is actively pricing in the risk from the White House, openly challenging Fed Chair Jerome Powell.
Over building renovations, of all things.
Yeah, seen as maybe trying to remove him for cause, and that directly challenges the Fed's independence, which is crucial.
So that could lead to
Uh,
policy mistakes.
Policy errors, exactly. And it just erodes credibility. You see it reflected straight away in a higher VIX, the market's fear gauge.
Absolutely. Okay, so our mission today for you listening is to cut through all that noise. I
Right.
want to clarify these often conflicting narratives, really pinpoint where the tensions lie, and most importantly, distill some actionable insights.
hmm
Insights specifically for you as you try to navigate this incredibly complex environment. We're aiming for those aha moments, seeing how these forces actually connect and play out.
That's the goal.
So let's set the main stage for today. The June Consumer Price Index, the CPI data, that drops at 8:30 a.m. Eastern. Normally, that report would just dominate everything.
Yeah.
But hanging over it, like a storm front, is this fresh geopolitical friction, this new, pretty aggressive tariff rhetoric.
That's right. That shift to tweet dependent means, well, political statements, often just thrown out on social media, they're now almost as impactful as core economic reports for moving the market.
Wow.
And this Powell political risk premium we mentioned, it means the market's genuinely factoring in potential instability. A direct assault on the Fed's autonomy
Yeah.
could even, escalate into a constitutional kind of clash.
Serious stuff.
It is. And that level of uncertainty gets baked right into volatility, pushes the VIX higher, makes everyone nervous. So our sources have laid out three pretty high likelihood scenarios for the next 24 hours. It all depends on how these two big forces, CPI and tariffs, interact.
Okay, this is where the intelligence we've gathered gets really interesting, because it doesn't just describe what's happening, it actually gives us probabilities for each potential path forward.
Mm-hmm.
First up, scenario A, hawkish escalation.
Mm-hmm.
This one has a 35% probability.
Okay.
This is the one where June CPI comes in hotter than expected. So year over year, maybe above 2.7%, or the core month-over-month number above 0.2%.
And the Cleveland Fed's nowcast is already pointing that way, right? Around 2.7% year over year, 3.05% for core.
Exactly. So the trigger is there. And then the compounding factor would be the Trump administration really amplifying those tariff threats, maybe announcing new targets or confirming those proposed 30% tariffs on the EU and Mexico.
Or even that huge 200% tax on pharmaceuticals they've mentioned.
Right. If that scenario plays out, you'd expect a sharp risk-off move. Stocks sell off, especially things like rate-sensitive tech and those tariff-exposed industrials and consumer stocks.
And yields?
The 10-year Treasury yield would likely spike, and the VIX, that fear gauge, would definitely surge.
Okay, that's the hawkish one. What's next?
Then there's scenario B, pre-CPI stalemate or range-bound chop. Our sources actually see this as the most likely outcome, giving it a 45% probability.
The middle ground, sort of.
Kind of. In this one, the CPI report comes in pretty much aligned with what everyone expects. Moderate inflation doesn't really force the Fed's hand either way.
And the tariffs.
The tariff front stays relatively quiet. Maybe treated more like a negotiating tactic before that August 1st effective date.
Right, just posturing for now.
Yeah. If this happens, the big indices would probably stay in a range, volatility cools down after the CPI release, and then the market's focus pivots straight to Q2 earnings season.
Which is kicking off today, right? JPM, Citi, Wells Fargo.
Exactly. So in this scenario, it becomes much more about company fundamentals driving individual stocks.
Makes sense.
And finally, the more optimistic outlook. Scenario C, dovish de-escalation. This one gets a 20% probability.
Okay, the risk-on case.
Yeah. This involves CPI data surprising to the downside. So maybe year over year below 2.4%, or even a flat or negative core month-over-month reading.
And what's the compounding factor here?
The administration signals it's softening its trade stance, or, we get credible reports that negotiations are actually making progress.
Okay.
The market impact, a strong risk-on rally. Tech, growth stocks would likely lead the charge. The 10-year Treasury yield would fall.
Which increases the chances of a Fed rate cut down the line, cheaper borrowing costs.
Precisely.
So if we tie all this together, these scenarios really highlight why it's very much a stock picker's environment right now.
Yeah, not just buy everything or sell everything.
Exactly. It's not a clear market-wide risk-on or risk-off trend. We're already seeing that fragmented sector performance, like energy showing some modest gains, financials are pulling back a bit before they report.
That gets been mixed.
Tech's mix, yeah. And consumer defensive stocks, like, say, certain beverage companies, they're already feeling that direct pressure from the tariff threats. You can see it.
Right. And just to quickly touch on some other context floating around, we just saw new 25% tariffs announced on Japan and South Korea.
More friction.
Q2 earnings season is officially underway with those big bank reports today, the June FOMC minutes. Market seems to think that's mostly priced in.
Old news by now.
Pretty much. And even the Q1 GDP data showing that decrease, that's basically stale news in this kind of fast-moving environment.
Things move so quickly.
They really do. So with all these big macro forces swirling around, what does this actually mean for individual companies? We've drilled down into 5 specific stocks here.
Right.
And not just based on whatever's hitting the headlines, but really asking what fundamental or quantitative or even sentiment-based force makes this stock a critical focal point, like right now.
Exactly. We're looking for those immediate catalysts, the underlying why now. We want to make sure we're not just rehashing old stories.
Okay, so who's on the list?
All right, we've got Palantir Technologies, PLTR, driven by that continuous stream of AI contract news. Then there's Micron Technology, MU, which just faced a new warning about a potential slowdown in the second half of 2025 from an analyst firm. That creates a really clear conflict with its recent strong earnings.
Interesting tension there.
Definitely.
Yeah.
Then Autodesk, Inc., ADSK, it gapped up powerfully after calling off a potential acquisition, which really seemed to relieve investor concerns. Constellation Brands, STZ, is a direct target of those new tariff threats on Mexico. That's a huge vulnerability, given its beer production relies heavily on that.
Right. Very direct impact.
Very direct.
Okay.
And finally, GameStop Corp., GME. Here, it's not really one single news item. It's that persistent, really elevated short interest combined with extremely bullish options activity. That just creates an incredibly volatile setup.
Okay, a real mix. Let's zoom in on each of these then, because digging into these details, that's where, you listening can gain those crucial insights, those aha moments.
Absolutely. Let's start with Palantir, PLTR. Looking at the charts, they're basically shouting bullish.
Oh, yeah.
Yeah, strong long-term uptrend. It's consolidating just below that $148 resistance level. And the technical indicators, they're signaling strong buying momentum. You've got a positive MCD accumulating on-balance volume, which basically tracks buying and selling pressure.
So money's flowing in.
Looks like it. Quantitatively, short interest is really low, only about 2.5%. And there's a high bullish option skew, like 60.8% of options trading are calls. People are betting on upside.
And institutions.
High ownership there, too, over 60%. The overall sentiment, overwhelmingly positive. It keeps getting fueled by that constant stream of AI contract news, like that warp speed for warships program they have with the Navy.
So how does it react to CPI? According to the simulation.
Okay, our AI simulation suggests that if CPI comes in hot, PLTR might dip initially, but buyers would likely step in around its 50-day moving average. They probably see any weakness as a buying opportunity, given that strong defense and AI story.
And if CPI is cool,
then we'd expect a pretty sharp breakout above that $148 resistance.
Okay, clear picture for Palantir. Now, Micron. You said there was tension there?
Yeah, Micron MU presents a really fascinating conflict right now. The charts have actually turned short-term bearish recently. There was a sharp 4-5% drop on pretty heavy volume, and momentum indicators like mass CD and RSI, they're showing weakness, falling off. Quantitatively, short interest is low, MB 2.51%.
Right.
But, and this is the critical piece our sources dug up, maybe the paradigm shift moment for Micron.
Okay.
On July 11th, this was before that negative Edgewater research note about an H2 2025 slowdown was widely public.
Right.
We saw significant dark pool short volume. That's where big institutions trade off the public exchanges. 2.86 million shares shorted. That was over 42% of the entire day's volume in the dark pool.
Wow. So big players were betting against it before the bad news hit?
That's what it looks like. This isn't just an opinion, right? It's a concrete signal. Major players positioning for a downturn before the catalyst. Meanwhile, social media sentiment is still lagging, mostly positive, while the professional sentiment has clearly shifted.
So what does the AI sim say for MU with CPI?
It indicates that a hot CPI would likely act as confirmation for those institutional shorts, probably trigger more selling, maybe push Micron below that $117 support level.
And a cool CPI.
A cool CPI might lift MU along with the market, sure, but gains would likely be capped by that H2 slowdown narrative hanging over it. Might even give those shorters more chances to add to their positions.
Okay, that's a really key insight, that dark pool activity. What about Autodesk? You said that looked more positive.
Yeah, Autodesk, ADSK, is looking much better technically. It had that powerful bullish reversal, gapped up almost 5% on Monday. That was on double its average volume, too, after calling off that potential acquisition of PTC.
It's a strong buying conviction.
Seems like it. Short interest is super low, just 1.41%, and institutional ownership, incredibly high, actually over 100%, which can happen due to various reporting factors, but it shows deep conviction from large investors.
And sentiment.
Dramatically shifted. Went from negative, worried about the deal, to positive pretty much overnight after the announcement. Social media scores are very high, very positive.
So how does it handle CPI?
Our AI sim suggests that even with a hot CPI, ADSK would likely pull back a bit, but probably still outperform the broader market. It looks like it found a new base of buyers with a cool CPI. Should see a strong tailwind, maybe push towards those recent highs near $326.
All right. Now, Constellation Brands. The direct tariff hit.
Yeah, for Constellation Brands, STZ, the picture is decidedly bearish right now. It's trading in a clear falling trend channel way below its key moving averages. And it took that sharp drop on high volume directly tied to the tariff news on Mexico.
Which is critical for their beer production.
Absolutely critical. Short interest is moderate, around 4.7%. And while institutional ownership is high, here's another dark pool signal. Consistently high, dark pool short volume. Over 57% on July 11th. That suggests active institutional selling pressure.
So a negative feedback loop.
Yeah, the sentiment loop here feels negative and kind of self-reinforcing. Our AI simulation suggests a hot CPI would be doubly negative for STZ.
How so?
Well, you get the general risk-off market move, plus specific fears about inflation hitting consumer spending on things like their products. It could potentially break its 52-week low in that scenario.
And a cool CPI. Offers some relief.
Some relief, maybe. But the upside would be severely capped by that tariff overhang. That's just not going away quickly.
Got it. Okay, last one. GameStop. The powder keg.
Right. GameStop Corp. GME. Its charts are kind of neutral right now. Trading in this wide horizontal rectangle, support around 21, 22 $2, resistance up at $35.55. It's currently near the bottom of that range, and its RSI, a momentum indicator, looks oversold.
The quantitative stuff is where it gets interesting.
Exactly. Quantitatively, the stock is, a powder keg. Very high short interest, 18.9% of the float. That's the percentage of shares borrowed and sold short. It would take almost 5 days of average trading volume for shorts to cover their positions.
That's the fuel for a squeeze.
That's the fundamental ingredient, yeah. And then you have this extreme bullish option speculation. The put-call ratio is super low, 0.50, way more bets on the upside than the downside. Plus, significant dark pool short volume here, too. It all feeds into that classic retail versus hedge funds narrative.
So the simulation points to squeeze potential.
Significant short squeeze potential, yes. A market-wide risk-on event, or maybe just some company-specific catalyst like a cryptic tweet from Ryan Cohen, you never know.
Right.
Could trigger rapid call buying. Then market makers have to hedge by buying stock, shorts get squeezed in cover, stop losses get hit, and you could see a parabolic spike back towards that $35 resistance.
Okay.
Wow.
So this is where we really want to clarify those opposing viewpoints,
Yeah.
right? Get to that deep understanding, that aha moment. Let's go back to Micron technology.
Yeah, let's do that.
Because the intelligence we have highlights this critical conflict playing out. You've got these strong long-term fundamentals, the AI story, clashing head-on with this potent new short-term negative catalyst from that analyst note.
Exactly. Our sources show there are basically 3 distinct paths or viewpoints investors are taking on Micron right now. Let's lay them out.
Okay.
Path 1. The earnings report is the true signal. This camp argues, look, Micron's recent Q3 earnings were exceptionally strong. Bullish guidance, insatiable AI demand for its high bandwidth memory.
So the Edgewater note is just noise.
From this view, yeah.
Yeah.
The note about an H2 2025 slowdown, noise, and overreaction. This price drop is actually a prime buying opportunity for the long-term AI story. That's path 1.
Okay, makes sense. What's path 2?
Path 2. The analyst note is the leading indicator. This viewpoint says, hang on, the market is forward-looking. That Edgewater note, plus what our sources indicate were some cautious comments from Micron's own CEO, that suggests the memory cycle might actually be peaking. So that great Q3 report, path 2 argues that was the good news climax. The party's over, or at least pausing, and the market's now discounting future risks and a potential slowdown.
Right, looking ahead, not behind.
Exactly. And then there's path 3. This is really a sector rotation story.
Okay, how's this different?
This view acknowledges Micron's fundamentals are strong, sure. But it suggests the entire semiconductor sector has just had a massive run. It's overextended. So in this environment, with rising macro uncertainty from tariffs, from Fed policy, that negative analyst note, it just becomes a convenient catalyst for big institutions to take profits on high-flying tech winners like Micron and rotate into safer, more defensive sectors.
So it's less about Micron itself and more about a broader portfolio shift.
Exactly. It's about risk management at a portfolio level.
Okay, 3 distinct paths. So how do we resolve this? Which path seems to hold the most weight right now? This feels like that critical inflection point, that moment of clarity we're aiming for.
Well, if we connect this back to the bigger picture, and especially the new information we have, the single most impactful piece of evidence, at least for the immediate term, is that quantitative data.
The dark pool shorting.
The significant institutional short selling in dark pools before that negative Edgewater note was even widely known, that's the key. This isn't just an analyst's opinion anymore. It's real money, real capital being deployed based on a bearish thesis before the catalyst hit the mainstream.
So that new information forces an update.
It has to. It forces an update to that initial belief that maybe the strong fundamentals alone would win out in the short term. So our resolution with confidence is this. For the immediate 24 to 48-hour trading window, that bearish narrative, backed by the catalyst and that institutional positioning, is expected to dominate.
Okay.
We'd put, say, 75% confidence that the bearish catalyst will outweigh the strong fundamentals in the immediate short term, especially around this volatile CPI data release. And that's where understanding the why behind these moves gives you, the listener, real leverage.
That's a fantastic clarification, a real aha moment connecting the dots.
Yeah.
Okay, so this whole deep dive, it's all about actionable knowledge. Now that we've unpacked these forces, resolved that key conflict in Micron, what does this mean for your strategy? Our sources provide some concrete action plans.
Yeah, really well-defined approaches. These plans include clear triggers, what needs to happen to initiate the trade confirmation signals to look for, price targets, and probabilities.
All right, let's hear the top ones.
Okay, the top-ranked plan, with a 75% probability assigned by the sources, is actually a bullish action plan for Autodesk, ADSK.
Interesting. The bullish one ranks highest.
Yeah, the trigger is a decisive hold above its recent gap-up level, around $292, and then breaking through the $300 resistance. Confirmation would be things like continued above-average volume, maybe some bullish analyst upgrades following the news.
And targets.
Price targets are $310 and then potentially $326, which is its 52-week high. The strategic rationale here is that ADSK just has the clearest, most positive company-specific story right now. It offers some relative safety in this volatile macro environment.
Okay, makes sense. What's rank 2?
Rank 2, with a 70% probability, is that bearish action plan for Micron, MU, we just discussed, anticipating a continuation of its recent downtrend.
Triggered by hot CPI.
Yeah, the trigger would likely be a hot CPI print, pushing the price to break and close below that $117 support level. Confirmation would be selling volume staying high, maybe more negative analyst commentary trickling out.
Targets on the downside.
T1 at $113.52, that's a one-month low, and potentially T2 down at $108, which is its 50-day moving average.
Yeah.
This is seen as a high-conviction short-term trade, really validated by that critical dark pool activity we uncovered.
Gotcha. What's next?
Third-ranked plan, another bearish one, this time for Constellation Brands, STZ, also with a high 75% probability. The trigger is a decisive break and close below its key support level of $159.
Confirmation.
No positive news on the tariff front, obviously, and continued high-volume selling, maybe analyst downgrades. Price targets are $150, then potentially $145. This is just a direct play on that primary market fear right now, the tariff impact.
Makes sense. How about GameStop?
GameStop GME comes in ranked 5th, but still highly impactful. It's a bearish action plan focused on a range breakdown, given a 70% probability. The trigger is a clear break and close below that key support at $21.89.
And confirmation.
Negative volume balance accelerating. Maybe it's RSI staying weak, below 40. The target would be $18.73, its 52-week low. Now, this plan explicitly acknowledges the short squeeze risk is always there.
Sure.
But based purely on the current technical setup, a breakdown is seen as the higher probability outcome.
Okay. And Palantir, bullish plan.
Yes, finally, for Palantir PLTR, ranked 4th, we have that bullish action plan for breakout continuation with a 65% probability. The trigger is that decisive break and hold above the $148 resistance level.
Confirmation needed there, too.
Definitely. You'd want to see daily volume really expand, maybe over 90 million shares, and continued strong call option flow. Price targets are $155, then $160. This is seen as a strong trend-following play, riding that AI and defense narrative, but best entered after the breakout is confirmed.
Okay, fantastic. Really concrete plans there. But, a true deep dive isn't just about what's happening right now. It's also about understanding the ripple effects, the second-order consequences these events create.
Absolutely. That's crucial. Take the pressure on Constellation Brands, STZ, for example. It's not just about that one company's stock price.
Right.
It serves as this really important test case for the entire consumer sector, maybe even broader. Its direct exposure to those Mexican tariffs forces a market-wide second-order question.
Which is?
Which other companies share these vulnerabilities? Which others have these kinds of geopolitical supply chain risks hidden in plain sight? This could trigger a whole market re-rating of that kind of risk.
Potentially benefiting who?
Potentially benefiting more domestically focused companies, maybe at the expense of those with really complex global footprints that are suddenly looking riskier.
Interesting. And you mentioned Palantir's valuation earlier.
Yeah, that's another fascinating second-order effect. Palantir's PLTR, sky-high valuation. It seems to be forging almost a new kind of valuation framework in the market. Let's call it national security tech.
Explain that.
Well, traditional metrics might scream overvalued, but its performance is being driven by these huge government contracts accelerating commercial AI adoption. The market appears to be implicitly valuing PLTR as this strategic hybrid. It's part defense contractor, part high-growth AI pioneer.
And willing to pay a premium for that.
Exactly. Willing to pay a strategic premium that potentially makes those conventional valuation models, less effective, less relevant for this unique niche it occupies. It's changing how the market thinks about valuing certain types of tech companies.
Fascinating. So wrapping this up, what does this all mean for you listening? Today's deep dive really showed us a market caught, didn't it? Caught between these huge macro forces, CPI on one side, tariffs on the other.
Definitely caught.
But also, it's a market where these very specific company catalysts, and even those subtle signals like the dark pool activity we found, are shaping vastly different outcomes for individual stocks. We've tried to clarify those opposing viewpoints, really shed light on what is a truly complex investing landscape right now.
And this raises, I think, a really important question for every investor listening. In a market that's driven by both screaming headlines and these subtle shifts in institutional positioning, how do you actually stay ahead?
Yeah.
Understanding these underlying conflicts, seeing how they resolve, anticipating those aha moments we talked about, that feels crucial right now.
And as you think about how to navigate all this, maybe consider how quickly today's fresh news, like those tariff threats, becomes tomorrow's stale news.
It happens fast.
The real leverage, it seems, comes from understanding the why behind the market moves, not just reacting to the headlines. How today's big fear could be old news tomorrow if a totally new catalyst emerges. Understanding that deeper context gives you so much more perspective.
Absolutely. And if you want to be the first to get these kinds of insights, the sharp confrontation of ideas, the actionable plans derived directly from the latest intelligence we gather, making sure you're always just a step ahead, while make sure you hit that subscribe button.
Yeah.
That really is how you get the fastest and most frequent updates from us.
Couldn't have said it better. Thanks for joining us on this deep dive into the market's cross currents today. We'll be back really soon with another stack of fresh sources to unpack for you.